Hi everyone, John Boardman, CEO of Ballast. Thank you for joining us. Joined today by Andy Reynolds, our Chief Operating Officer and Partner, and Cameron Hamilton, who is our Director of Financial Planning and Partner. So a lot of stuff in the news these days. Markets have been, a little volatile over the last several weeks and months, frankly. Year started kind of on a negative note, and then over the last several weeks we've seen sort of a recovery and then a little bit of a retrenchment. So a lot of it's via headlines, inflation, markets, earnings, interest rates, growth from here. So I thought, sort of as a follow-up to our last video that we did, this would be a good opportunity to talk about where we are. So let's just jump right into market conditions and kind of what you all think, kind of what's going on in the markets right now, what's causing some of the volatility, and kind of where we might be headed from here.
Sure. Yeah, I can jump in. You guys can chime in. I think, so markets-wise, I think people would be surprised to see where the market has gone if you haven't been paying attention, enjoying your summer as you should be. We saw almost a 20% recovery off the bottom going back to mid-June to mid-August. We've had a little bit of a pullback since then, and we don't want to get too caught up in the month-to-month, but that quick of a move off of such a quick move down at the beginning of the year, I think people, if you're just looking at one statement or 2 months of statements, I think people will be really surprised to see the market having moved that much. Surely the headline news has covered the markets and whatnot. But really, I think the markets are trying to figure out where we're going. And I think we're all trying to figure out where we're going. The short-term momentum right now, we'll talk about all the information that we're looking at today, but the short-term momentum is really unknown of what the market's going to do between now, the end of the year, the next 6 months, the next year. The Federal Reserve's trying to figure that out as well, with what interest rates, what they're going to do with interest rates and inflation. So I think right now the biggest thing that the market is trying to do is figure out where we're going. And I think most economists are too.
Yeah.
So in that, I think clearly the headline has been the inflation numbers, and if you guys, one of y'all want to talk about that, I think that is playing the biggest impact in the market, and the Fed's reaction to that as well.
Yeah, I mean, I was telling a client the other day, I said, the market's always sort of a tug of war between good factors and negative factors and trying to figure out which way the economy's going. This is a little bit like two of the world's strongest man competitors playing tug of war. Bigger, bolder factors than we've dealt with in a long time. Historically low unemployment, a lot of cash on the sidelines, which are good tailwinds, but also inflation that we haven't seen in decades, and gas prices that we've never seen before.
Right.
What's going to win in this? And that's why I think you're going to see this type of volatility, which is not daily. It seems to be like multi-week volatility, where you'll see a trend build and then reverses in the other direction, positively or negatively. And so,
one thing I've been watching, and I think it'd be a fun thing for our clients to watch, is growth versus value. We've been telling the long-term story about growth having its time for the last 10 years and maybe value coming into play more as inflation is high and rates rise. But this year, first quarter, growth really got beat up. Value held its head up more during that rally period. Growth beat value by probably 10%, and now it's flipped around. So it feels like the market's kind of vacillating on, risk on, risk off. Is it more important to be having profits and fundamentals? Or are we still going back to that kind of story-based economy? It seems like it is.
Yeah.
Flipping.
But it's interesting though, because if you look over the last 12 months, the growth recovery in the last few weeks has been significant, but there's still just massive destruction in some areas of the tech space.
Right.
And we had said that in the last video that, some of those names that have gotten really crushed off 60, 70, 80%, they haven't really seen that much of a recovery. And so which makes me think that the market is really discerning which of these companies actually can get to profitability. Which
Sure.
ones are actually going to grow into the shoes that the market said they were, months ago.
Right.
Yeah.
And I think just it's the tug of war also is macro versus micro. Where when does pricing matter again? It's like we've been talking about pricing for years. Like, when does pricing matter? And we're seeing that. We're seeing the macro issues. So the market is really trying to figure out what matters now. And we're out of the COVID world. Where do we go? And I think that's that big tug of war. I think that's a good way to put it.
That's exactly right. Yeah, and the inflation story, as you mentioned, I mean, that's the headline. And I think the market recovery that happened a few weeks ago, that continued for a few weeks up until, call it a week or two ago, was largely to do with this impression that the inflation data appeared to be cresting. I mean, it was still high. I think it went from 9 point something to 8.5. And so this idea that, okay, it's bad, but it's not getting any worse. It's hard to look at one data point and sort of assume that is the reversal of a trend. It could easily post a higher number this next report, but it was clear that the markets were specifically looking for some amount of news that would say that the Fed can eventually get to a point where it can stop increasing interest rates. I mean, that lever that they have, they want to see that they're eventually going to stop using it. And maybe it's just increasing rates and holding at some level, but at some point, these 3/4 point increases, if they keep coming, it's just a little scary to the market. We're getting to territory we haven't been in a long time.
Yeah, and we kind of have a situation now in the short medium term where good news can be bad news, because every good inflation number, good jobs earning number can be bad news if it brings more Fed action and puts the brakes on us again. And so it kind of goes back to which company are you cheerleading for? If you're cheerleading for a growth company that hasn't proved their metrics yet, you do not want interest rates to rise and the cost of capital to go up. Whereas if you're kind of a value investor thinking about those more mature companies, is it bad to have interest rates higher over the medium term? I'd argue that it's not.
Yeah. I mean, there's some different, the changes in the marketplace, they go all the way into where some of these companies are just raising money at the venture capital level. You mentioned cost of capital, but what's happened with a lot of these, what I would call high beta, long duration technology names, where great idea, maybe not a profitable business. If you look at sort of what it requires for them to get to that point, it's capital. They need fresh capital coming in constantly. So not only is it more expensive, but the capital fundraising environment has changed to a point where they can't get capital at the frequency or magnitude that they did even a year ago. So that, I think, will have ramifications on a lot of things for the next several years.
I read an interesting commentary from a capital allocator, the type of person who is running hedge funds and family offices, and they said they were putting a lot of dollars into early stage venture capital right now, but not late stage companies that look like the IPO is 12 months, 18 months down the road, because their perspective is, we don't want to catch this patch of volatility, but we are still doing that for the long term.
And they're probably worried about the valuations too at that point. What price are we buying in, not buying in here? Let's talk about the consumer. We're approaching the end of August, so still a few months, but the holiday season feels like it starts earlier and earlier every year. This is probably going to be a big holiday season for at least measuring how strong the consumer actually spends, but how they feel sort of going through that. So you'll have any thoughts kind of on the consumer and where they are right now? And
surprisingly low in consumer confidence, and I think I wrote about this 3 or 4 weeks ago in one of our commentaries about consumer confidence, and it was low then and in the Michigan study, and it's even lower now. So going back to 1980 levels, the 1980 recession obviously was what that was marking. And it's really interesting. I think it's a tale of two different situations we're looking at, as we were talking about earlier. So you have the consumer whose confidence is being challenged by gas prices, in which gas prices come down a little bit, and thank goodness they're not $7 a gallon like everyone is afraid of over the summer. But they're still higher. You're looking at inflation. You have to go purchase a new automobile, and I hope for anybody's sake watching this, they didn't have to purchase one, because that was not a fun purchase price. And where they go from there, and housing is more expensive, and everything's just more expensive. And so if you're on a fixed income, or if for people who are on pensions or something like that, that's a challenge. Mm-hmm. Or if your wages haven't gone up, that's a challenge. So rightfully so, consumer confidence is low. I get it. But what's also interesting on the other side of the coin is people are still spending. And so, it's supply and demand, basic economics. The demand is still there to keep the inflation high, to keep prices high. And spending, depending on what you're looking at, what data you're looking at, still is pretty good. So how long that can continue will be a big question. What happens, how things are purchased, if they're purchased in the holiday season, whether they're purchased with money people have or with credit card debt, or home loans or spending accounts or whatever it is. I think those will all be really interesting things to keep an eye on as we go through the next 3 months.
Yeah, I mean, the inflation number hitting above 9%, I think the average consumer seeing that headline, paying attention to the news, what that says is I just got a 9% cut in my consumable income. So that my money is just not going to go as far. So that's naturally going to knock people's confidence down. And then layer on top of that a reminder every time they go to the gas pump that they're spending $20, $25 more than they were just a few months ago. It's hard to imagine that there could be a worse environment. It'll be really fascinating to see, at least from a confidence standpoint, it'll be fascinating to see with this pullback in gas prices. It's still elevated, but it's been a meaningful move.
346.
Yeah, exactly. So that's
come down $1 national average. I looked this week.
Yeah, so you're talking 25% off the top, probably, at least. And so, will you see that sort of, associated increase in confidence? I'm not really sure. I mean, there's still a lot of other stuff in the news that's affecting the consumer.
Yeah, sentiment report has bounced, but the question is, can that be sustained through kind of the holiday season? Because that's where retail sales make it happen. I talked to a business owner whose business is kind of scheduled around making that big set of sales in Q4, and if they're a barometer, I think that those companies maybe are a little bit more conservative in how much they want to be building inventories, and you can kind of look at sentiment affecting retailers like Walmart and Target. You're hearing stories about them paring back a little bit. I think that's the worry, is that the downturn in sentiment becomes a self-fulfilling prophecy that stops us from having growth. That would be the bad scenario we don't want to occur.
Yeah. There's the psychology of the consumer may actually be the strongest factor.
And the word recession floating around out there on news cycles nonstop, that doesn't help either. So that's going to be a continued headwind for confidence when you feel like you're in a recession. Everyone's telling you you're in a recession. Yeah. The data may or may not show that, but... Yeah,
I mean, how many conversations have you had over the last few months where, maybe someone who's maybe more naturally fearful about things and how they might play out, they say, this tough time going into recession. I'm like, well, how are things going for you? Oh, pretty good. The reality and the perception of the environment. I think there is this expectation that there's sort of, worse times ahead. But to your point, that could be somewhat self-fulfilling if everyone convinces themselves of that. Yeah. So, but the recession, we've talked about this. A lot of people use the 2 quarters of negative growth as a way to classify a recession, but technically that's not what titles a recession. It needs to be that independent board that essentially brands it as a recession, and they're dealing with that right now because we're seeing that negative growth largely through government spending cuts. But what we're not seeing is the other things that you would need to see as part of a recession, which is that retrenchment of the consumer, and other activities, particularly employment, that would make you think that this is sort of an economic storm. We're just not seeing that. Yeah. Maybe it's lagging.
And ultimately, what does it matter if we're drawing that fine line? I think it's more important. Are all the meters reading red or green? It's mixed.
That's right.
And that's kind of the outlook, right?
Yeah, and I mean the actual label of recession typically happens after we're out of it anyway, so maybe it's insignificant.
And not all recessions are made the same, which is basically what you're saying.
Yeah.
Not all recessions are the financial crisis, which
that's
is
right.
Everyone's most recent, thought of a recession.
Right.
I think looking forward over the next, between now and January, I think it's going to be really important. Eyes on the consumer. What does the consumer do? can the consumer be responsible but still spend to keep the economy going? All of a sudden, do we have all this new credit card debt or new debt that was created over the holidays? And then the Federal Reserve, what do they do? And I think those two things are really important drivers of, all these other impacts that are affecting the market and the economy. And then to your point earlier, are we back in, the 2013s, 14s, 15s, where good news or bad news becomes good news for the market again? And that it was a weird time when that happened.
That's exactly right.
You see bad data, but then the market jumps up.
Yeah, I mean, let's go back 14 years, 13 years. I mean, the Fed was cutting rates to zero to keep the economy just to have a pulse. And now, really raising rates, inflation's obviously the primary factor, but that's essentially to pour cold water on the economy. I mean, you can't have it both ways, right? I mean, ideally we're somewhere in between those, but this is just part of that long-term economic cycle that investors just have to get accustomed to. So let's talk about actionable items, things that, we always get those questions. And as we're talking with clients, what are some of the things that, people can be thinking about? Every environment, I think, is a good opportunity to think about your situation maybe a little bit differently. As we've written in the past, great market times, good opportunities to pay off debts, things like that. Markets are down, Roth conversions, but this is one of those volatile periods. So what are some things that we as advisors are sort of talking to our clients about?
Yeah, it's interesting that we're kind of in a emotionally middling period because we're off the highs, but we've tested a lower amount, but we're not back where we would like to be. So you can kind of make the argument for any of those, based on exactly how you play it. So you could say, we say all the time, make sure you have the cash on hand that you need to have. If you're not comfortable with your allocation, let's discuss it. And maybe we got to a point where, the market was 20% off and you were fearful of creating liquidity. Well, now it's less painful to do that. So maybe it's time to revisit that conversation. But conversely, we could be having discussions about, taking your RMD for this year, forwarding, inherited IRA, RMDs, Roth conversions. Those conversations, depending on which security, might still make sense. And I think another conversation we should always be bringing up is the charitable giving conversation. With volatility affecting different sectors to a different degree, that could bring up opportunities in specific areas. So, I had a client who bought some Exxon a year ago. It's doubled. The market obviously isn't up 100%. So that's a great opportunity to say, do we still want to hold this amount? Or can that be something that is appreciated, donatable security? And that was the ultimate decision we made there. But, just really it's always be thinking. And always be kind of discussing what are the goals, and we'll try to find a good spot for you.
Yeah.
I think right now, the way I look at it, I've talked to a couple clients about this, is look, we're never going to hit the top of the market perfectly. If we do, we got lucky, right? Like, no one has a crystal ball. We can't perfectly time that. If you take a more historical view, go back 5 years, go back 10 years, we're we've seen a nice market rally. So if there are things that naturally should be getting done this time, maybe you're a little early to be changing your allocation to a more conservative portfolio. Maybe you don't quite need liquidity, but next year you might. I think it's a good time just to take some chips off the table, make good decisions. Now's probably not a time to be greedy. It's probably not a time to take excessive risk. Look at everything we're talking about. The word recession's everywhere. Let's not get our head over our skis, but at the same time, things look fairly priced in the market. So I don't think we need to get too conservative either. So I think, just to your point, like, be responsible. You got somewhat of a do-over if back in June you were getting anxious. Now you got a little bit of a do-over. We don't know what the fall will bring. We don't know what the next couple of years will bring. So if there are good fundamental things you should be doing, now is a opportune time to do it, I think.
Yeah, I agree. And I also think, as we've talked about inflation, with that number being more elevated than we've seen in a long time, wouldn't be a bad idea for us to update your plan and think about maybe some higher inflation figures. We've always priced in higher than normal inflation, but We're not pricing in 9%, and we don't believe that that's where we're headed in any
Right.
sort of long term. But this would be a good opportunity to throw a few curveballs at the plan. I think what we have found and will continue to find is that the plans are holding up really well,
Right.
but it can really help instill confidence in people if they can see, wow, I can actually survive this even if inflation's a little bit higher than I was expecting.
Right.
So
Another exercise I've been doing on that same front is making sure the spending kind of feels like the spending we were expecting. And one easy way for people to figure that out is just take a snapshot of your bank accounts now. You don't have to make any changes. We can go back and look, this time January or February, have a nice track record to see what you're spending, and then just compare that. Is this what we're planning for reality? That's kind of how we do, reverse budgeting, where it's, we don't need to see everything you're spending your dollars on, but it's nice to have kind of a good beat on what you are spending and what we're planning around. So it's a nice time to do that with prices up. How has that affected me?
yeah. Well, I think it's probably a good time to wrap it up.
Yep.
Thank you for watching today and listening. If you have any questions or concerns about anything we've talked about, please reach out to us. Obviously, call our office. And then also visit our website, ballastplan.com. We'll have this video if you want to rewatch it. But again, we appreciate your time today, and we're here to answer any questions you might have. Thank you.